Assalamu alaikum friends, welcome to today's standard. Today's standard is IFRS 2 share-based payment. This is a new standard. It is not taught in financial reporting. This is introduced in your SBR. Okay, share-based payment is a long standard, and definitely you can expect a question on this area because it is new to SBR. Right, and this is the first part. This video I have divided it into three parts. First part I will be discussing the equity settled share-based payment and the modification, cancellation and all. Second part I will be discussing cash settled share-based payment and hybrid models. Okay, hybrid means you are using equity as well as cash. And third part I will be doing questions. All your test your understanding will be covered there. Okay, so what is a share-based payment? Before we go into the payment, how we can pay, we first need to understand what is the share-based payment. Okay, see, share-based payment occurs when you're giving your employees shares or share option. Okay, it's like you are not paying in cash like salary. Sometimes you might pay them in shares or share option. Then how do you recognize that in your financial statements? This is a complex area, right? So for that we have IFRS 2. So when you're giving them shares or share options, it's like a transaction. Okay, you are giving employees for the valuable service they have given to your entity. You are giving them shares for that or share options. So they have performed their part, the services they have given, and on return now you are giving them shares and share option. It's like for goods and services. For buying goods and services, you have to pay cash, right? So same way, employees are giving services to the entity. For that, you entity have to pay them shares or share options, not in cash, but you are paying in shares or share options. So all the share based transactions are recorded under IFRS 2. Okay, now there are two types of transaction. One is known as equity settled share based payment, the other one is settle in cash, and IFRS 2 applies to both. Okay, so when it's equity settled share based payment, the entity acquires goods or services in exchange for equity instruments of the entity. Equity instruments means, for example, shares or share options. And if it's cash settled, it's easy to understand that you are paying in cash. You are acquiring goods and services and you are paying in cash, but by reference to the entity share price. We definitely have lots of questions on this area, so you don't have to worry in the beginning if you are struggling a little bit, because this is a new area, so I'll be going slow also in this area. Okay, what is a share option? Share option, we know it's like we are giving the holder to buy a share in the future for a fixed price, that is known as exercise price. So that means you decide today that at this price I'm going to buy the share in the future. The exercise price, it's known to you. If the exercise price is less than the fair value of option at the exercise date, that means when you are exercising the option, then the option holder is essentially getting a discount, and so the option is said to be in the money. That means you are buying at a lesser price. You are buying at exercise date. At exercise date, if exercise price is less than fair value, you are getting a discount because you'll be buying at a lower price. So it is known as in the money, right? This in the money you will understand if you are very good in options, because you are buying at a lower price than the fair value of the share. So it's a discount for you, which is good for you. And most share-based payments are share options granted to employees. So most of the time in the exam also you will see this, that this is the share options which are granted to employees or even directors also as a part of their remuneration. This is one of the very common area for your exam. Most of your revision kit questions are the share options granted to employees, share options granted to employees. So now we are moving towards equity settled share-based payment. The accounting treatment, the measurement, when we modify what happens. So this is when an entity receives goods or service as a result of an equity settled share-based payment. You debit the expense or an asset because you have to pay, right? You are paying, so it's an expense from you. It does not matter now you are paying in shares or share options, but from the company's point of view, it's an expense, so you debit. Or if you are giving an asset, you debit. Expense on an asset. We'll understand later why it's an asset also. We credit the equity because equity right? We credit the equity. And where do we write this equity? It is written in other components of equity. So share capital is not affected until the share-based payment has vested. We'll definitely understand what is the meaning of vested after some time. Okay. Your share capital will not get affected because of your share-based payment until it is vested. So this will be covered a little later. Now we are going to go through the measurement. Okay. Share-based payment are measured at fair value. But there are complications in how to determine this fair value. Okay, you need to go through this. Is the transaction with employees or other providing similar services? Is the transaction with employees or others providing similar services? You see, the word is similar. The services has to be similar for you to decide a fair value. Because you are giving shares and share options, it's hard to find fair value. Why? Because you have to see whether other companies are also giving shares or share option to their employees, and what is their value. You need a reference point to determine a fair value. We don't have an active market for this to see, okay, this is a fair value. Because this does not normally happen in all organizations that they give shares or share options. Only very large organizations, they are willing to do this. So you are saying, are there anyone who are giving similar services to the employees? If it's no, can the fair value of the goods and services received be measured reliably? At least the goods and services that you're receiving, what is it? That means your employee has worked for, let's say, 20 years or 5 years also. Can you value that? Can you measure that fair value? Because entity is receiving, for entity, say goods and services in IFRS 2 means the services that employees have performed. That is known as goods and services. Okay, so don't get confused with the normal goods and services. If still you cannot determine, measure at the fair value of the equity instruments granted at the grant date. Okay, so for example, whatever the value of the share option or the shares at the grant date, when you are granting it to the employees, that day whatever the fair value is, you take that as your fair value. And you must remember this chart. This chart you must remember. You cannot forget this. Otherwise, you will not know how to measure the fair value, which fair value to take. Sometimes there are more than, you will be given fair value on different dates. You should know at which date fair value must be used. If, now let us go again, start from the beginning. If we can see that we can find other organizations who are giving similar services. If yes, measure at the fair value of the equity instruments granted at the grant date. Okay, same like here. So again here, if it is yes, at the grant date, whatever the fair value of that option or shares, you take it. So for this two, it is same. The only difference comes here, the second box. Can the fair value of goods and services received be measured reliably? That means for the service. If it is yes, then measure the fair value of goods and services received at the date they were received. So whenever you have performed that services, that day you will be receiving it after you have completed. Let's say you will get a share option if you stay in the organization for 2 years. You have been there in the organization for 2 years. You have to stay there for 2 years. So if you leave before 2 years, you will not get it. When you stay there for 2 years, after 2 years, what is the fair value of that day when you're receiving it? That share options. That fair value you have to take. Okay. What is the grant date? It is the date when an entity and another party agree to the arrangement. They decide, okay, in future, you are going to get this share option and you are going to get this number of shares. So that is known as grant date. These things you have to know. What is the meaning of grant date, fair value? These things are heavily used in IFRS 2. Now let us go to the timing. Timing matters a lot in IFRS 2. Okay. Some equity instruments vest immediately. Some immediately. You don't have to wait for the future. 1 year, 2 year or 3 year. Okay. The holder is entitled to the instruments immediately. So in that day, the transaction is accounted for in full. On the grant date itself, you account for that transaction. Okay? You debit the expense and you credit the equity on the grant date itself. If it is vest immediately. But when share options are granted to employees, there are normally conditions attached. Okay? Normally, even in the exam, also, you will see in your exam questions, they will not give you freely like this share option, share option, share option. They will give some conditions attached to it. That if this happens, they will get the share options. If this happens, they will get the share, or they will not get. One example is a service condition may exist that requires employees to complete a specified period of service. This is very common condition that they have to complete a specified period of service. That means this many years they have to provide service to that organization before they are entitled for their share options. Not every employee in the organization gets the share options and all. Okay. Especially for example, you have newly joined an organization. It's very unlikely that you are going to get the share options. But those who have stayed there for 2 years, 5 years, 10 years, they are more likely to get their share options because they have been there and they have given services to the organization. This is like a way of, you can say, you are motivating employees, you are encouraging them so they stay in your organization, and also they increase the value because they want to increase their share price, which is the objective of the shareholder also. Because if they increase the share price, and when at the date of the exercise, the shares they will receive, if the share price increases, they will be receiving more shares, so the value of the company will go up. They will try to increase the share price, you see. So it is both helpful for the employees as well as for the company also. So this is a way of, you can say, encouraging employees, but not all employees. Some classes of employees gets this. IFRS 2 states that an entity should account for services as they are rendered during the vesting period, the period between the grant date and the vesting date. Vesting date means that day when it will be, finally they will be entitled to receive that amount, or they will be receiving the shares or the share options. Options will be exercised that day. Between the grant date and the vesting date, they have to account for the services. That means it will be divided between these periods, the services they are performing. What is the vesting date? It is the date on which the counterparty, the employee for example, they become entitled to receive the cash. That day employee will receive the cash or equity instruments under the arrangement. Okay. So you need to recognize an expense. Expense needs to be recognized for that. It's an expense for the company. You are giving shares and share options. Employees are receiving, but you are losing out. Now, let us go through this illustration. When to recognize a transaction, very important. So you have been given 3 years, year 1, 2 and 3. So from 1 to 3, okay. Year 1, okay, this is the starting point. This is known as grant date. They will be granting you share options and all shares. Vesting date, this is the date when they will actually exercise their share options or they will receive the shares, the employees. From year 1 to year 3, this is known as the vesting period. Possibly same as the required service period. Yes, mostly it is equal to a service period. If you are 3 years in the giving services, so you can say vesting period is 3 years. And from 1 to 3, there will be fair value will change. So charge fair value. So that fair value when you have to charge between the 3 years over the vesting period based on options expected to vest. Not all options will be exercised. So if you expect the options will be exercised, it will be that fair value will be spread across the 3 years. Okay. And fair value determined at grant date. So you need to know when you have to use that fair value at grant date. And on the vesting date, calculate the actual charge based on the number that vest. You're calculating the actual charge. That means actual expense for you on that day. On the vesting date only, you will know what is your actual expense. How many share options has been exercised? How many shares employees have received? Before that, you are just estimating from year 1. So it's like you just expect. Performance conditions, very important as performance condition. Another area that could be asked is from this, because your share price or shares are based on some performance conditions. That means this condition some needs to be satisfied before you can receive the shares or share options. One example, such as achieving a specified increase in entity's profit, the completion of a research project, or achieving a specified increase in the entity's share price. They will say that if the share price has increased from here to here, you'll be receiving this many shares, right? Another thing you need to know. Performance conditions are classified into two. One is known as market condition, the other one is known as non-market condition. And both you need to know. What is market condition? It is related to the market price of the entity's equity instruments. For example, share price. It is something which you cannot control. It is based on the market. For example, if they say entity must get a minimum share price, they must achieve this much of share price. Minimum at least they must achieve by the vesting day. That means when they are going to actually receive the share, by that day, this much share price they must have achieved. For the scheme members, okay, scheme members means those employees who are there under the scheme, who are entitled for that to be eligible to participate in the share-based payment scheme. Understand? So this is a market condition, because share price is not something which you can control. It's not in your hand. It's based on the market. What about non-market performance condition? These are not related to market price. Examples are your EPAs, profit target. They will tell you. So this is like a summary for conditions which are attached share-based payment. Okay. Vesting conditions. Okay. These are conditions which are required to comply with for share options to vest at the vesting date. You have to, these are some conditions which you need to comply with to get that share option. Okay. One is known as service condition, the other one is performance condition. Performance conditions, as we can see, are divided into two, market and non-market. Okay. Service conditions means how long the employee will be there in the organization. And when it is market conditions, what you should do? Take it into account when determining the fair value of the option at the grant date. So we take this in determining the fair value of the option at the grant date. Example has been given to you. Okay. Entity share price. That is one example of market conditions. Or any performance which is related to the entity share price. Non-market is not related to market, like your EPS or your profit target and all. This is taken into account at each reporting date when estimating the number of options likely to vest. So now we are moving towards what is the impact of the performance condition. If it is market-based conditions, they have already been factored into the fair value of the equity instrument at the grant date. Please understand that. That means market conditions, whether you achieve or not, you still will get your share options. You will be vested. So therefore, an expense is recognized irrespective of whether market conditions are satisfied or not. It does not matter whether you satisfied or not, because it has already been factored into the fair value at the grant date. So, but you recognize an expense. Okay. Whether market conditions satisfied or not, under both conditions, expense will be recognized. It's an expense. You are giving shares and all share options. Okay. To employees. What about non-market based conditions? This must be taken into account in determining whether an expense should be recognized in the reporting period or not. You have to take. If you satisfy the condition, you recognize the expense. If you don't satisfy the condition, I mean the non-market based condition, then you don't recognize the asset. For example, they tell you that you must achieve this much of profit. If you're not able to achieve that profit, you don't recognize expense. But if it's about share price and all, that does not matter. Even if you have not achieved that minimum share price, you still recognize an expense. accounting after the vesting date. In that diagram we have been given till the vesting date. What about after that? Okay, so no further adjustments to the total equity should be made after the vesting date. After the vesting date, if the fair value changes, if anything happens, the share price goes up and down, anything happens, you don't have to adjust it to the total equity. Okay, even if some of the equity instruments do not vest, for example, because a market-based condition was not met, still you don't do any changes. But they must transfer any balance from other components of equity to retain earnings. Okay, we'll definitely do questions on each so to understand this. Now we are coming to the modifications. Modifications to the terms on which equity instruments are granted. Equity instruments are granted. Whenever you see this word, it's like shares and share options are granted. What are the modifications to the term? They may alter some conditions when they are giving options to employees during the vesting period. Okay, so these are some changes, and this changes you should know it because you can be asked a question from this area. I have seen 2-3 questions on this area, modifications. It might increase or reduce the exercise price of the option. So they might increase also or they might reduce also the exercise price of the option. This is modification, means you are making some changes to that share option scheme. So increase or reduce the exercise price is also known as a modification only. So this makes the scheme less or more favorable to employees. Okay. Second, it might change the vesting conditions. Vesting conditions might change to make it more or less likely that the options will vest. Now, if a modification to an equity settled share, equity settlements you are settling by giving equity shares and share options under shares. Okay, you're not paying anything in cash. So if modification is to an equity settled share based payment scheme occurs, the entity must continue to recognize the grant date fair value of the equity instruments in profit or loss. You recognize what? Grant date fair value of the equity instruments in profit or loss. Unless the instruments do not vest because of failure to meet a non-market based vesting conditions. What does it mean? Unless the instruments do not vest because of a failure to see, when you failed to meet a non-market based vesting condition, you instruments will not vest. Okay, so on that day, that fair value will might be different. So you have to take that fair value. If it is non-market based conditions which has not been satisfied, because of that, if the instruments are not vested, then you have to use that date, not the fair value of the grant date. If the modification increases the fair value of the equity instruments, what happens? Then an extra expense must be recognized. Yes. Because of modification, fair value of your share increases. That means now you have to give more shares or more share options to your employees. So it's an extra expense for you. So where will the difference go? So the difference between the fair value of the new arrangement and the fair value of the original arrangement. Now there are two arrangements. One is the old, original, the old. Now is the new. So the difference between the two fair values, where will it go? The incremental fair value. That means the fair value have increased now after modification. At the date of modification must be recognized as charge to profit and loss. At the date of modification, that means when you are modifying at that day, not before modification or after modification, will go to profit and loss because it's an expense now. So this extra expense will be spread over the period from the date of change to the vesting date. Until you don't vest, it will be spread. That means you divide it between number of years. Let's say your vesting period is 3 years. So that extra expense would be divided by 3. It's like that. Okay. Now, cancellation and settlement. So modification part is over. Now we are moving towards cancellation and settlement. Because we know an entity may cancel or they may settle a share option scheme before the vesting date. It's possible, right? Before the vesting date, they might cancel it or they might settle it. Then what? If the cancellation or settlement occurs during the vesting period, that means before the vesting date, the entity immediately recognizes the amount that would otherwise have been recognized for services received over the vesting period. They will immediately recognize it. Otherwise, they would have recognized at the vesting date, but now before that they will recognize. That is known as an acceleration of vesting. That means before the vesting date, they are recognizing it as an expense. Okay. So any payment made to employees up to the fair value of the equity instruments granted at cancellation or settlement date is accounted for as a deduction from equity. Yes, because you are paying them equity, you are paying them shares, so this will be deducted from your equity and it will be an expense. So up to the fair value at that date when it was cancelled or when it was settled. Next, any payment made to employee in excess of the fair value, okay, of the equity instruments granted at the cancellation or settlement date is accounted for an expense. That means fair value is more than the fair value when you are cancelling and settling is more than the fair value originally, right? When it was not going to be cancelled or settlement was going to be done before the vesting period, you will be given the two fair values and the excess of it will be recognized as an expense. Okay, so I thought I will take so much of time to finish the equity settled share based payment. That's why I told that this will be done in part 2. But I finished it quite early, so why not cover the cash settled share based payment also in this part, right? So examples are this. These are two examples. These are the only two examples, and make sure that you know the two examples. One example is share appreciation right, SAR. Share appreciation right, where employees become entitled to a future cash payment. You see, employees will receive this cash in the future. Based on what? Increase in the entity share price from a specified level over a specified period of time. From one level, they will increase to another over a period of time. That is known as share appreciation right. That means share went up, the value of the share. So based on that, you will be receiving more cash now, and the employees. That is one type of cash settled share based payment. The next is the right of shares that are redeemable, thus entitling the holder to a future payment of cash. Okay, right to shares that are redeemable. You can redeem the shares and receive cash. So these are the two ways, and the accounting treatment we'll see. This is easy. Based is easier than equity based. Okay, cash based, you debit profit or loss and asset because you have to pay in cash, so you have to debit in profit and loss as an expense, and you credit liability. Here you don't credit equity because nothing to reduce from equity. You are paying in cash, so you credit liability. Why credit liability? That cash they are entitled in the future. Today when you are recognizing it, it's a liability for you. You still didn't pay them in cash. You see, so finally at the end when you will pay them in cash, you debit that liability amount, liability cancels off, and you credit the cash. Okay, this is initially. What about the measurement? They remeasure the fair value of the liability arising under cash settlement at each reporting period. Every year, fair value of liability will change. So you have to remeasure it at the fair value of the liability. Okay. This you need to remeasure if it's cash based. Did you see there's a difference between equity settled share based payment? What is it? Where the fair value is fixed at the grant date. If it was share options, it was fixed at the grant date, not like fair value of liability. Okay. Allocating the expense to the reporting period. Same way, under equity based, you have to allocate expense. Under cash based also, it's an expense, you need to allocate it. So where services are received in exchange for cash settled share based payment, the expense is recognized over the period the services are rendered, vesting period. This is the same principle as for equity settled share based. So it is same. Let's say your vesting period is 5 years. You divide the expense by 5 years. So every year that will be the expense. It is same for equity settled transaction as well as cash settled. The difference, there's not difference. Now let us go through this illustration. This is a very good question to understand your past paper questions under IFRS 2. This is easier. You'll be given a little harder than this, but let's go through this. This is for your cash settled share based payment. Okay, an entity has a reporting date of 31st December. On 1st Jan, the entity grants 100 share appreciation rights. So the moment you see this, you should know that this is cash settled. Okay, to each of its 300 employees. So they will give you the number of employees. 100 to their 300 employees. On the condition that they continue to work for the entity until what? 31st December 2003. So this was given on 1st of Jan 2001. So 1, 2 and 3, 3 years. During 2001, during 2002 and during 2003. What happened? 20 employees leave. Entity estimates that further 40 will leave. They estimate further 40 will leave during 2002 and 3. 10 employees leave. That means actually they left. Entity estimates that further 20 will leave during 2003. During 2003, 10 employees leave. Okay, so now let's see how you need to account for this. The fair value of the SR, you will be given like this only. Okay, fair value of SAR for all the 3 years is given. Why? Because we told we have to remeasure the liability at each reporting period. So the fair value of SAR will be different for every reporting period. Not like the how we are given under equity share based payment. Calculate the expense for each of the 3 years of the scheme and the liability also to be recognized in the statement of financial position as of 31st December for each of the 3 years. Definitely in the exam, very rarely they ask for each of the 3 years. They will only ask for any 1 year, maybe 2001 or 2003. So now let us go to the solution. This is how you need to do your work. You will see liability at year end, expense at year end. Definitely you don't have any opening balance, so your expense and liability will be same in 2001. How did you calculate it? You see, they told 300 employees. So from 300, you are minusing 20 because 2020 in 2001 20 are leaving, but 40 are expected to leave in 2002 and 3. So this 40 also you are deducting. So 300 minus 20 minus 40. Okay, and how many you have? 100. So multiplied by 100. And what is the fair value at 10? So you are multiplying it by 100 because there are 100 share appreciation right into 10 because the fair value at that date is 10, and you need to divide this by 3. You see, into 1 over 3 because 3 years from 2001, 2001, 2002, 2003, which will be 80 and 80. Come into the second year. When it is 2002, what happens? Here 10 are leaving and 20 will leave during 2003. So you minus 300 minus 10 minus 20. So 300 minus 20 minus 10 minus 20. Okay, what is this 20? The other 10 and 20 are this, okay? This 10 and this 20. And the other 20 was this because they have originally left. Okay, they have actually left. That even for 2002 you have to take it like that only because next year obviously there will be less employees now. 300 minus 20, we are not taking this 40. This 40 is an estimated figure. Only for 2001 you take it. When you are coming to 2002, it's 300 minus 20. What actually have left minus 10 minus 20. Okay, and same 100 share appreciation right here. The fair value is 12 into 2 over 3 now. 1 year went by, so it's 2 over 3 because you came in the second year. You need to know these fractions also. So it's 200, okay, and expenses 120. So definitely you will be getting an expense of 120. Okay, how are you getting the liability at year end as 200? It is simple. With this 80, you add this 120. That means it have increased by 120. So then your liability at the year end becomes 200. Okay. But definitely when you calculate it like this, that is a way of doing. If you would have given if you would have got the expense, but now this 200 you will get by calculating this, you will get 200. So it's 200 minus 80. The difference only you will write it as an expense in the current year. You see, 200 minus 80, 120. Come into the third year. Third year you don't have to do anything because it will be 3 divided by 3, which is 1. So that's why you are just taking the fair value into 50 and 100 share appreciation. From 300 you have to minus 20 because this have actually occurred in 2001, 10 because it has actually occurred in 2002, and this 10 in 2003. Okay, so you will get 390, and the difference, it has increased by 190, you can see. So 190 is the expense. Okay, so the fair value of the liability is remeasured at each reporting date, you see, from 8200 390. But the expense is spread over the vesting period. That's why you have taken 1 over 3 here, 2 over 3 here, and then 3 over 3 means 1. So if you don't have to show that 3 into 3. If you don't write it also, it's fine. Now let us go to the value of the share appreciation right. Okay. Share appreciation rights may be exercisable over a period of time. Okay. So the fair value of each SAR, they compromises the intrinsic value. What does it mean, intrinsic value? Intrinsic value means the cash amount payable based upon the share price at that date. Whatever the share price at that date, based on that only cash amount will be paid to the employees. Also, it has a time value. Because we know option have two things. Option has intrinsic value as well as time value. So share appreciation right is also like that. Means if more time is there, share price will vary over. It takes more time for share price to vary. Okay, if share price is increasing, more time is given, you will be more likely to receive a cash if share price increases. So there's a value of time, there's a value of intrinsic value also. When SARs are exercised, they are accounted for at their intrinsic value. That means share price at that day, the exercise date. Okay, the fair value of SR could exit its intrinsic value at this date. The fair value of that could exit whatever the value at that date. This is because SR holders do not exercise their rights at that time, have the ability to benefit from future share price rises. So they could exit. So at the end of the exercise period, intrinsic value of SR will equal its fair value. The liability will be cleared and any remaining balance taken to, finally your liability will be cleared at the end, and remaining balance will be taken to profit and loss. Because when you exercise it, at that date, your intrinsic value as well as the fair value of SAR will be same. Okay, so we have a question, we have a test understanding on that. If you can see, we have been given intrinsic value as well as fair value in your test understanding it. Now, we are replacing a cash settled with an equity. We can do that. Then what you do? So they might modify this might come under modification. You know, you're changing. So you might modify the terms of a cash settled based payment so that it becomes classified as equity settled. So if you are changing the share cash to equity, then what do you have to do? You have to measure the transaction by reference to the modification fair value of the equity instruments granted. At that date, whenever the equity instruments are granted, at that date, you have to see the fair value. De-recognize the liability. You have to de-recognize the liability because now you are changing from cash to equity. So under cash, you have recorded liability. But when you're changing to equity, there's no liability. There is equity. So you de-recognize that liability which you have recognized under cash settled scheme. And now recognize equity because it's an equity settled. To the extent of the services rendered by the up to that modification date, whatever the services they have you have received. Okay. Next, recognize a profit or loss for the difference between the liability derecognized and equity recognized. Whatever the difference is, you recognize it in profit and loss. Okay. Now other issues. Hybrid transactions. What if it's a hybrid transactions? That means here entity is given a choice whether to settle in cash or whether by issuing equity instruments, by giving shares or share options or by giving cash, how they want to settle. Then if they are given that option, the scheme should be accounted for as a cash settled share based payment if the entity has an obligation to settle in cash. If they has an obligation that they have to settle in cash only, then it is classified as cash settled share based. It's easy, cash. But if no obligation exists, then it is equity settled share based payment. But this is when entity is given a choice. You must see this also. But what if it's not the entity, it is the counterparty? Right? Some entities enter into share-based payment scheme that gives the counterparty the choice of settling in cash. Or what if the counterparty? That means your employee has the choice whether they want in cash or equity instruments. Then it's different. So you have to see always who has the choice of going for equity versus cash. If it's the entity, you see whether they have an obligation. Obligation in cash, it's cash. Obligation not in cash, it's equity. But if it's the counterparty, then the entity has granted a, that means you have given a compound instrument to your employees. Compound instrument means it has both the features of debt and cash. Sorry, equity and cash. So you must split this. Okay. Part as recorded debt and part is recorded as equity. Debt is for the cash part. Okay, because we have a liability under that. So debt and equity. We do a very similar thing to IFRS 9 also. We have seen that when we have compound instrument, we need to split between equity instrument and debt instrument. But this is not IFRS 9, but in IFRS 2 also we have to split between equity and debt part. Same like how we have done for IFRS 9. But IFRS 9, we are not bringing the rules here. Now, group share based payment. What is a group share based payment? A supplier might receive goods or services from employees or suppliers, but the parent or another entity in the group might issue equity or share based payment. Cash settled share based payment as consideration. For example, when you are buying a subsidiary, okay? As a consideration, the parent might issue equity or cash to the subsidiary. Then how you deal it? A subsidiary, you see, subsidiary is receiving goods and services. That means it's receiving services from employees. And the parent has to, no, he will be paying, right? They might issue equity or cash, the parent, as a consideration. So in accordance with IFRS 2, the entity that receives goods and services is a share-based payment arrangement must account for those goods or services. The entity that receives, whoever is receiving the good or services in a share-based payment arrangement. This is for group, okay? So we see the receiving party who receives goods or services must account for those goods or services irrespective of which entity in the group settles the transaction. Even though it's the parent who settles the transaction, but who must account for it? The one who is receiving the good or service, that is the subsidiary. In this case, it is the subsidiary who is receiving goods and services, but parents are settling in equity or cash. But IFRS 2 says, does not matter whoever settles it, but the one who is receiving should account for those goods and services. or whether the transaction is settling cash or share does not matter. Whoever accounts for it. So it is the subsidiary who should account for this because he is receiving goods or service. Now let us go to the disclosure. Uh, just yes. So we are almost towards the end before we actually start questions. So these are the main disclosure. Description of the share-based payment arrangements, how you are arranging it and all. Number of share option granted or exercised. Total share-based payments expense. Okay. So disclosure should be in such a way that enable users to understand how fair values are determined. Because to determine fair value in this area is a little bit critical. So you need to show them through your disclosure. Now we are again going back to our conceptual framework's definition of an expense. What did conceptual framework defines expense as? A decrease in economic benefit that results in decrease to equity. Okay. So in a case of cash settled share based payment, what happens? Entity has an obligation to pay cash. So this clearly meets the definition of an expense. Right? IFRS 2 meets the definition of conceptual framework's definition of expense, right? What about equity settled share based payment? Here they are providing equity. So there is no reduction in an asset or increase in a liability in accordance with the definition of an expense. Okay. IFRS 2 requires recognition of an expense. Okay. So you recognize expense, that is okay. That goes in accordance with the recognition criteria. But it can be argued that this is not in accordance with the definition in the framework. Yes, you recognize expense for equity settled share based employees under IFRS 2, but it does not go in line with the definition of the framework for conceptual framework's definition of expense. Okay. Because it argues that employee service, this is why they say expense or asset, because they believe that employee service is an asset that is received by reporting entity, that but then simultaneously consumed. So they might say it like this: employee service asset. Okay, they are taking employee service as an asset, debit, equity, credit. And when it's an employee service debit, employee service credit, the asset part. When you're receiving, okay, so then you deduct the asset and you debit the profit and loss because you are paying. So all these things are not so much needed, so I'm not going to go much on these things. This is they are trying to say when it is according to the idea that if employee services are taken as an asset. Okay, so you can read this on your own. Now let us summarize what we went through. We went through share-based payment and we told what is it, what are the types of transactions, and what are the basic principles. We went through two payments. One is equity settled share-based payment, the other one is cash. When it's equity, how do we measure? We debit expense, we credit equity. When it's cash, we debit expense, we credit liability. Okay. And in terms of spreading expense, it's the same for both. Then we had some modification, cancellation, and settlement. Accounting treatment of modification is different, and accounting of cancellation and settlement are same. Okay. That's why cancellation and settlement are taken together. They're not different. Only modification is different. Okay. So that's it. Now we'll be doing test your understanding. So see you in part 2 where I'll be solving questions on IFRS 2. Before I move to the next, I will be completing my other standards. I'm almost done with all the standards. What I think 4 more standards are left. One is IS 28, the associate. The other one is IFRS 3 and IFRS 10, consolidation and business combination, and IFRS 9, financial instruments. I have already started it. Some parts I've covered and some are remaining. So I will be covering the rest of it tomorrow. Financial instruments. Inshallah, and then by this week I'll be done with all the standards before I move to the revision kit questions. So till then, take care and see you in the next standard.